Good morning. My name is Seth, your Metro Detroit real estate expert. And today, as always, I have my friend Steve Frost with me to give us some superior insight on what happened with the Fed meeting yesterday. But before I do that, I'm just going to kind of touch on home prices a little bit. I don't have too much to get into, but there is some data that just came out this month that I wanted to share. So, on a month-to-month basis, nationwide, homes are appreciating at 0.6%. Now it sounds low, but actually it's getting more towards, shall I say, pre-pandemic levels, to where if you own a house, you're on average get anywhere between 6.5% and 7% appreciation rate a year, which is actually a good thing because when we were in our peak, we were looking at almost like a quarter, like 25% increase in your property. And here in Metro Detroit, just last
Shout
year,
out
we saw
homeowners.
exactly. We just saw just in this past year a 12% appreciation rate, and then the years before were substantial as well. So that's nice to know. But here in Detroit, we're still kind of rocking and rolling. We're at 1.9% a month, which is going to kind of land us if we keep going that way, right around like the 20% again. I think that as time will go on, that might go down just a tad bit. But here in Detroit, we are still seeing some crazy low inventory. On a nationwide basis, we're at 3.4 months of inventory. And then here in Detroit Metro, we're still sitting under two, right under two at 1.9. So until we
Crazy.
see that inventory unlock, we're not going to really see those home. Uh-oh, I'm lost. Oh, there I am. Okay. I got lost for a second. We're not going to see that. What was I saying? We're not going to see that
The
that
moderation.
appreciation. Yeah, that appreciation unlock until we start seeing some more inventory come to the market. Other than that, Steve, we had a Fed meeting yesterday. Can you clarify what's going on there?
Yeah, the Fed, this was at first. I apologize for my lighting. This is I'm at my home office, which is in my new house, and it's kind of interesting because this is gonna have really nice lighting, but I don't know if you can see this or not. My ceilings are black, so it makes it so makes my lighting really bad. Oh, now that's a little better. Anyway, at one point it will be really cool. But anyway, all right. So yes, the Fed met, and this was a really, really important meeting because the markets had assumed the Fed was going to cut rates three times was the big assumption, and then the last 2 months, inflation data has really kind of reared its ugly head again, and it's made the inflation um, the inflation numbers just came back a lot hotter than they thought. So a lot of the markets were kind of like, okay, now we might only see the Fed cut rates once. There were some people, some talking heads saying, hey, the Fed might raise rates again because they can't get inflation under control. And so Jerome Powell came out yesterday and just said, hey, look, like we plan on, our plan is to cut rates three times this year, and we are going to stick to that plan. We understand that inflation is a bumpy road. There's going to be some months where it's high and some months where it's low. And they also know that the unemployment market is also or the employment market is going to fluctuate a little bit too. So the job market is fairly hot right now, but the Fed came out and just said, look, we get it. We get those things are going to go up and down, but our plan is still to cut rates three times this year. And we saw some market improvement yesterday. Probably see rates, where they were trading on a national average just over 7%. And now we're probably getting closer to that, like 6.75, 6.875. And hopefully, the kind of the hangover from that meeting will continue to see a little bit more positive data, and we'll start to see rates improve a little bit from there. That being said, when you do talk about rates improving from there, without the Fed actually cutting rates or saying when they're going to cut rates or doing anything specific, the improvement that you're going to see is to maybe like 6.5, 6.625. It's going to take some time before we really see that, before we see the rates really start to move meaningfully. But what does that do for somebody that's in the market right now? Well, we know that rates are definitely going to come down. They think that the Fed thinks that by 2026 they'll have brought the Fed funds rate down closer to 2.5 to 3%. So that rates are going to go down at some point in time. But like you just talked about, especially in this Michigan market, is right now the values are going to continue to go up. So when you're out there looking as a home buyer, you have to balance, like, okay, do I wait and pay less interest However, I'm going to pay a higher price for the home. Like, what is the cost of waiting? Or do I buy something now and refinance myself? So, there's definitely, two different schools of thought. And it's, I always go back to it's, can you afford, do you need to move? Yes, I need to move for A, B, and C reason. Okay. Can you afford what the payment would be today? Yes. Can you find a house where you want it that meets your needs? Yes. Well, then you should move. And then you can always refinance and lower your rate. I have clients now that we did rates at like 7.5% back in the late last year, who we are now refinancing to the mid sixes. And so
Mm-hmm.
those people are already saving a full percent on their loans. And those homes were actually dropping some of their PMI. They put 10% down, and the homes appraised high enough to drop their PMI and all kinds of different things. So the options, don't be afraid that you're going to get locked into one rate forever and that they're bad. There's definitely some opportunity out there.
All right, good deal. Anything else to add on today?
Nope, that's it, man. Don't have
All
don't
right.
have a whole lot more to add. The markets are fairly quiet, and we'll I'm gone next week, but hopefully the week after we'll have some more good data for you.
All right, good deal, Steve. Yep, like he said, we're going to be taking a break next week for spring break, and we'll be back the following. Thanks, guys.
All right, thanks, man.